My job is really to provide the fundamentals on the economy. As many of you know, oftentimes we get involved so much in our day-to-day job that we need to fall back a little bit and say, well, what's that broader picture? What are the things that I need to factor into my business decision making? And economics is that. Economics provides the fundamentals. It's the first 5 or 10 minutes of the asset liability meeting that I work with at Wells Fargo. It's the first 5 or 10 minutes of the credit committee at Wells Fargo, the strategy meetings, the board meetings. And this is what we do. And some of the graphs here are indeed part of that process. So here you see the economy continuing to grow in the U.S. And basically, for the last 5 years or so, the U.S. economy has grown at about 2.25%, 2.5%. That's it. I know some people say, well, let's get 3%, let's have 4%. But basically, on average, the U.S. economy is doing fairly well at 2.5%, 2.25%. It is a little bit slower than historical averages. Some people will tell you about the great old days of the 60s or the 70s or the 80s. But it is different. And there are some fundamentals behind it in terms of labor force growth and productivity. But if I'm a business planner on a national scale, I'm still thinking 2.25%, 2.5% is what we have for growth. Now, this graph illustrates something that's pretty significant in the last 6 to 9 months. You'll notice there are 2 different lines here. And one line is services. That's the ISM non-manufacturing number. And that number really is kind of intriguing because if you look at the services number, it's remarkably steady. And on a historical basis, it's pretty strong. The manufacturing is what has taken the hit. And that manufacturing impact is the combination of the dollar and the West Coast port disruptions. The dollar is important for San Francisco. As I was talking with Peter last night at a reception, it's important to understand that when you look at the different S&P 500 investment sectors, and they break it down into 12 or so sectors, the one sector that is most international is IT. Over 50% of the sales of IT products in the United States are done abroad. And so when the dollar is very, very strong, and it probably will get a little bit stronger, it does have an impact on the value of earnings for IT companies in the United States, and that impacts negative. So I think when you're thinking about where am I going for the next 6 months to a year or two, the strength in the dollar is actually a little bit negative for IT earnings in the United States, and that, of course, is very significant here in this region. This is personal consumption, and Wayne will talk a little bit more about personal consumption. But once again, you'll notice the steadiness. And what is interesting about this year, 2015, is consumer spending is coming in stronger than it was the last 2 years. Consumer spending has benefited from the wealth gains in terms of the stock market and housing. It's benefited from stronger employment gains, better wage and income gains. And so what you see here is now the consumer is actually leading the U.S. economy. And the strength is there, and it's a little bit better than it's been the last 2 years or so. Now, this is one of the other challenges we need to think about. This is the Fed's outlook for inflation. And for those of you that are investors or business people and you need to refinance something in the next 6 months to 2 years, what makes this graph interesting is notice the Fed is projecting that inflation, as measured by the PCE deflator, is going to be about 0.8% this year. But then it jumps to 2% next year. That's going to have a significant impact on bond portfolios in your 401k or your IRA or your pension plan. It's also going to tell you something about interest rates, particularly at the longer end of the curve. Oftentimes, you get into these discussions and people say, well, the Fed's not changing interest rates, so interest rates aren't going to do anything. But if you do a graph for the last 6 months or so, you'll notice, yeah, the Fed hasn't done anything. But guess what? 10-year treasuries have risen 50 to 70 basis points, depending upon where you start. So again, it's kind of intriguing. What's happening is the market is discounting more rapid inflation going forward. That's going to have an impact. And particularly if you need to refinance something in 3 months, 6 months, or 9 months, you might find interest rates on the refinancing aspect of your business higher than what you might have expected otherwise. So again, it's kind of intriguing when you look at that. So this is, again, the Fed's look at where they're going to tighten policy going forward. And then I'll talk a little bit about the evolution of San Francisco. I was asked to talk a little bit about, some perspective about San Francisco. I know that, in the middle of what you look at right now is an absolutely fabulous period in San Francisco economic history. We also have to have some perspective. And, one of the issues we talked about last night, Peter and I, continues to be an issue that I talked about here 4 or 5 years ago, probably have said every year, is just housing affordability, and you'll see some of that going forward. So here's perspective. It is a cyclical economy. There are ups and downs. So when you're doing your planning for the next 3 to 5 years, please don't draw a straight line, all right? Because it's not going to happen. There's going to be good years, and there's going to be that 1 or 2 years that's not going to be so hot. And please make sure you put enough money aside somewhere in the piggy bank to realize that when you look at employment growth in the San Francisco metropolitan area, there's a definite cycle. It's also nice to see that you've long since passed the 1999-2000 peak in terms of employment in the metropolitan area. So once again, if you want to know why the traffic is bad and no one can afford a house, this is it. Okay, you've just got too many people employed with too many good jobs. You need to send the jobs out somewhere else, maybe Cleveland or Pittsburgh or something like that. This, I think, is very interesting. I thought it would be interesting for you to see the evolution of employment in the San Francisco area, and because oftentimes we overlook certain things. What's intriguing here is notice the tremendous increase in trade, transportation, going from basically 21% in 1990 down to 15%. So that kind of the business, that kind of the trade business, the transportation, the wholesaling, sort of diminishing a little bit. But look at education and health. One of our speakers later on is from the education sector. Definitely growth from 9 to 12%. Leisure and hospitality, again, more hotels, more restaurants everywhere. Again, another growth sector that you see. And then finally, professional and business services. Again, very much San Francisco is a professional city. So when you look at this, you can see that evolution of the city in terms of where it's going, what kind of jobs it's creating, what are the sectors that you're specializing in over time. And you look at manufacturing, how manufacturing has gone from 7% down to 4%. Much less of a manufacturing city than it was in the past. And then the kind of population demographics, I think, is, again, very, very fascinating. Makes San Francisco a very unique city in terms of the percentage of Asian population here. Again, and that's rapid growth and that rapid change over time. Median home prices, we're looking at San Francisco, Oakland, California, National, and I also put a high-tech city in there, Boston. Once again, San Francisco far above the peaks of the past. Much more rapid gain in the last 2 or 3 years. You can see that in every recession or near recession, those prices do come down a little bit. So for those of you that are holding out, there's a little bit of hope. Not much, but a little bit. But you see, Oakland, surprising to a lot of people, has picked up pretty dramatically in terms of median home prices. You can see the national numbers. And once again, it just suggests that for this area, and as many of you would say, but to me as an economist, one of your great problems is that you got no place to put anybody. I mean, you're landlocked. This is it. So unless you start building apartments at the bottom of the Golden Gate Bridge, I don't know what you're going to do. I mean, I guess you could do what people in Hong Kong do and just build houses on top of the bay, do it that way. But other than that, no. I mean, this is it. Median home price is really kind of neat. Housing affordability, you can see again, San Francisco. What I found interesting about this graph, and we talked about it with some clients, is look at Oakland, that little hockey stick kind of kick up. So you can see that what's happened is, again, yes, San Francisco's got very expensive, more expensive all the time, less and less affordable. But what you also see in terms of housing affordability is Oakland is starting to become a little bit of an interesting story with the migration of people starts to hit that area. And all of a sudden, you get the big jump there. And you can see, looking at California, the U.S., in terms of housing affordability. So these are apartment rents and then office rents. And once again, you can see how San Francisco is really out of line with the rest of the country. I mean, just so much prosperity, too many, as I said before, too many jobs, too much income, too much happiness and joy. You know, I don't know what you want to do. I know you beat Cleveland in basketball. Maybe you want to send them a couple 100,000 people and something to help them out. But anyway, you can see here, again, pretty rapid growth. And again, perspective is important. You're probably not going to get this kind of rapid growth for the next 3 to 5 years. As Peter and I both do this presentation again, and Peter's photograph gets more and more aged over time. But you'll see, again, that's pretty rapid rise compared to the national pace in terms of apartment rents and office space. So again, very much a huge upswing and very much a reflection of the prosperity overall for the city in terms of where we're going. And then a little bit on our economic outlook. So I'll just finish up just by, again, going over those fundamentals. Good economic growth. A little bit of concern with respect to the impact of the dollar on IT earnings abroad, and some perspective on that. Some of you are pretty familiar with what's happened with China in terms of their economic slowdown and their adjustment over time. And then, again, some concern about inflation picking up. That would probably have a little bit of an upper push in terms of interest rates going forward. And for those of you that are into refinancing and thinking about elements like that, I think that's a key as well that you want to look forward. And just finally, some perspective. Just remember, you're in the middle of an amazing upswing in the San Francisco area. But at some point in time, for some reason, no one really knows at this point in time, there will be a shock to the economic system. There will be some disappointment. And again, make sure you call upon Peter or someone at Wells Fargo to make sure you don't get too far over your skis.